Hi and welcome back to another episode of Invest with James. Today we're looking at bonds and investment bonds. We're going to delve into one of the most overlooked areas of investing, which is investment bonds, and how it has great potential for your portfolio. So before we get started, please hit the subscribe button and share. This does great for the YouTube algorithm so it can help reach more people. I really appreciate that. So let's get stuck in. So what exactly are investment bonds? Well, they're nearly a hybrid between savings and investments, and it's a way to diversify your investment portfolio. They offer a fixed interest over a set period, so it allows you to have a stable income and allows your money to grow. So let's get into more of the terminology, how they work. Bonds are essentially a debt security, and therefore you are lending money. So that's why they're often government bonds or corporate bonds, where you are lending money to the government or the corporation, company, and they offer you a fixed return. For them, it's a cheaper way to raise capital, but it gives you security as an investor to loan the money for a fixed amount of time. Very often, the government bonds are mostly spoken about because they are the most secure. Then you have the corporate bonds. These are the larger companies that want cheaper capital to use towards funding. So there are four main components in bonds. You have the face value, that's the current day value. Then you have the coupon rate, that's the interest rate that you'll get paid. You have the maturity date. These are often in years, very often they're between 1, 5 or 10 years. Then you have the yield, that's the rate of return that is paid, its price, coupon payments, and the time to maturity. Another key benefit of holding bonds is you can hold them inside your ISA or your SIP. That allows you to have the tax-free benefits, so tax is not taken from any of your earnings. That's always a great benefit. Many people ask about the flexibility of bonds. They are very similar in their function to shares, so you can sell them and buy them as you want to. The bond is locked in, you are not locked in to hold it. You can still sell it on the open market like you would any other stocks and shares you can buy. Now, what influences the performance of bonds? So as we saw, you have the bond price and you have the yield price. Let's first look at the interest rate. That has the biggest effect on yield prices. The interest rates. Bond price and interest rates have an inverse relationship. So as you see interest rates rise, the bond prices go down. And as we've seen in the last 6 months, the interest rates have been hiking quite a lot, so the bond prices have been coming down. And that is to match a neutral area called the market yield. As we can be fairly certain that we have nearly reached the peak of the interest rates, with the view that over the next few years, interest rates are going to fall because inflation is under control and the economy is looking much stronger. With that in forecast, we can be fairly certain that the yield prices will start to recover from that. So we'll see while interest rates go down, the bond prices will go up, but the yield will not go up. Now let's take an example of that. If you buy a bond for £100 and you receive a 6% yield on this, when the interest rate goes down, the yield will no longer be issued at 6%, it will be 4%, 3%. So it makes the bond more valuable because the bond has a better return on it over the long term. So you can benefit from locking in now on a higher yield with a view that the value of that will also increase because it's more attractive as interest rates start to fall. Other factors that influence the bond market are the credit quality. The credit quality is linked to the ratings that are given to governments and corporations and the like. The better the rating, the more secure and stable they are. They typically as well have a lower rate of return. If you go towards the risky end, they're often called the junk bonds. You will get a higher rate of return, but they are much more riskier. You also have to be aware of the economic conditions. The economic, such as the GDP growth, employment levels and etc. They all influence how attractive bonds become. Because they're stable, very similar to gold and silver prices, when there's geopolitical issues, people always hedge towards the more stable funds and investments. Therefore you have bonds, gold, silver. We also have inflation expectations. If the inflation is becoming under control, you start to see that the yield prices is being pushed down as well and the bond price is going up. Again, keeping an eye out for government changes of policies is always important. But when you're looking at the bond market, you're looking over a term of 5 to 10 years on a typical basis. So let's have a little look at a couple of these examples of bonds in the current market. I'm going to look at bonds on two of my favorite investment platforms. So first we'll look at InvestEngine and then we'll look at FreeTrade. On the FreeTrade, the bonds are much easier to search for because it is only ETFs and bonds. If you search for bonds, you can just look under the best returns and the yields. And as you can see here, the iShares Emerging Markets Government Bond at £34 with an 8% return is very attractive. You see also as well in the details description, they have a cap at 10%. It's very unlikely you'll see more than 10% as a return, but it also has a floor of 1%. So it allows for some of the volatility inside the market, but that's a guaranteed rate you'll receive. At least it's nice to lock into that one. Another alternative on FreeTrade, you can look, they have a separate section for treasuries, which is part of bonds investments. And you can see the UK Treasury bill has a monthly maturity, so it's a very short term. But you'll see the rates are very attractive at over 5% here. You can also look on in your investment portfolios, in your ISA, SIP, or if you want them in your general account. You can look for bonds as there well, and the best performing one I can find is a global high yield, which is offering nearly 6.5% on global corporate bonds. So that's lending out to the largest companies in the world. It's a very attractive offer. The reason bonds are much more stable is because you are the first creditor in line if anything happens to the company. That's why it's always worth diversifying your risk. As much as it's lovely to chase the higher risk, higher reward companies, when there's risk of maybe some volatility in the market, say with the geopolitical issues we have now, only over the weekend we had news coming out of the tension in Iran, other developments on the Gaza. These all cause tension, which could cause the market to be a little bit uncertain for the next few weeks, even into the next few months. Of course, longer term, it will recover. But if you are sitting on the fence and thinking, I'll wait for a pullback, I'll wait for prices to come down because it is a little bit high, maybe that's your view. Maybe bonds is a great alternative for the moment. Maybe just invest into bonds in the month or 2 months that you're looking at riding out. It shows you're getting a return on your money better than it's sitting in the bank, right? So that's all we got for you today, covering some nice investment on investment with bonds. So let me know what you think. If you're a bondholder, it'll be great to know. Drop a comment below and don't forget to like and subscribe to the video, and I look forward to seeing the next one. Take care.